Thank you. I have a question about too big to fail. If we do not limit the size of financial institutions and we have a failure, even though the federal government can unwind that firm, there would, by definition, be large losses. So who absorbs those losses if they're massive? And if not the U.S. taxpayer, who?
Great question. So first of all, there are in this legislation, I think, a range of things that either create size constraints or positive incentives not to grow beyond a certain size. So as I said in my talk, higher capital requirements if you're bigger and if you're more interconnected. The legislation adds a kind of a modern day version of the deposit cap that currently applies to banks that looks at total assets on a risk-weighted basis, so that the problem with the current deposit cap is that it, in a sense, caps the safest kind of assets and then sends people to go elsewhere if they want to grow, and a range of things that fundamentally are risk constraining. But I think the question, nonetheless, obviously valid. The way the legislation works is that modeled on the current fiducia authorities that exist for the government with respect to banks, that bank holding companies or non-bank financial institutions that are of a certain size can, if they become insolvent, will be broken up, be done so in a way that is designed to insulate the broader financial system from the kind of contagion effect that was so prevalent in this last round of crisis. This is meant to be paid for in the first instance from the assets of the firm that is being broken up. But insofar as the predicate is insolvency, the whatever increment, and oh, by the way, I mean, I haven't gone through it, but the whole point of having higher capital standards and leverage constraints and so forth and so on is to minimize the chance of this happening. But in the case that you suggest, to the extent that the estate of the firm that's being broken up is insufficient to pay the costs, then financial firms will be levied for that cost, not the taxpayer. The statute very explicit on this question. The FDIC will levy a charge, basically ex post, on financial firms, big financial firms, who, in our judgment and in the judgment of the Congress, after all, would be the principal beneficiaries of the notion that the contagion effect will be dampened by this new process and that the financial system will be well protected. So first recourse is to the firm and its capital stack, its common equity holders, and so forth, and beyond that, financial firms.
Thank you. There's been a lot of effort to create a more stable situation in the financial system, these regulations among them, and to help put Wall Street on a firmer footing. But Main Street is still suffering a lot. And just today, there was an announcement that weekly initial unemployment claims increased to almost 480,000. And that means that the 4-week moving average has basically been stuck for about 8 months now. So what more could be done for unemployment more immediately than just waiting for a recovery to come, which many people think is going to be very slow in coming?
So there's no question there is, as I suggested in my talk, still an enormous amount of pain across America, felt by individuals and families and small businesses, the result of a very, very deep recession that we faced in 2008 and the beginning of 2009. I think there are now increasingly signs of a moderate recovery that is beginning to build. We have had now 4 quarters in a row of growth, 6 months in a row of job growth. There is still a lot more work to be done. And so the President, the Secretary of the Treasury, the administration generally, very focused on making sure that the government provides the appropriate basis for stimulus, while understanding that ultimately it's for the private sector really to generate jobs as it has done in the United States. We're focused on creating the conditions for that to happen and for that to happen at a rate that continues and ticks upward. So Congress is considering an additional stimulus package. The Senate acted on it last night. The House is going to come back in session briefly next Tuesday to act on it. That's an important piece. There is pending in Congress small business legislation that would provide incentives for small banks to extend credit to small businesses, a set of tax cuts that are targeted at small businesses that are really focused on job creation and economic growth. We think that that's important legislation. It has the support not only of the president, but of the Chamber of Commerce and of the small business community. We think that's an important piece. And so we believe that we are on a trajectory that is positive. As you note, the data that comes in is not even. So although we've added jobs each of the last 6 months, the week-to-week data and sometimes the month-to-month data has a certain amount of unevenness to it. And what it reminds us is we have substantial more work to do. I think if you look at where we are today relative to where we were a year ago or 18 months ago, we feel like we've made very, very important improvements, really on the basis of some really decisive stands that the president took and that the Congress took with respect to fiscal stimulus, with respect to efforts to repair the financial system, and now legislation that both reforms the healthcare system and the financial services framework. And we will keep on this path, looking at ways to create jobs through near-term stimulus. So that's what the legislation that's about to pass the Congress will do. Looking for ways to create additional incentives for the private sector to grow. I would note that if you look at the GDP numbers that were released last week, they suggest, I think, an important increase in the level of business investment and of private sector consumption that are, I think, further signs that this recovery is starting to take hold and to build. And these other efforts that I've identified are meant to continue that along, to help transfer the job creation to the private sector, which is where it ought to happen and should happen, and to do so in a way that is also responsible and credible within a broader fiscal context that our country has over the intermediate and longer term.
Hi. Public policy seems to focus a lot on startups and small businesses since those are regarded as engines of job creation. But in the U.S. alone, middle market companies account for about $6 trillion in revenues and 32 million employees. I mean, what has been your policy so far to provide incentives in that sector? And what steps do you plan to take in the future to strengthen it further?
Well, I think if you look at the administration's efforts, partly related to the Recovery Act fiscal piece, partly related to the tax initiatives of the administration, there's a lot of focus on investment in healthcare, in green energy, in a range of things that span sort of businesses, small, medium-sized, bigger businesses. So the focus on small businesses by no means meant to be exclusive of focus on finding ways to generate growth and job creation across the range of businesses by size or by geography or, for that matter, by sector. And I think you'll continue to see a set of tax policies that are focused on trying to generate research and development and technological innovation that both create near-term growth, but also, and importantly, are focused on things that are important to the longer-term health of our economy and of our country in other sorts of ways. So whether it's energy or healthcare, education, so forth.
You spoke really eloquently about the reforms of the 1930s and the criticisms that were made and what the outcome was. But clearly, those reforms didn't prevent crises in the future, including the most recent one. So my question is, if you were to look at the Dodd-Frank Act, do you believe it will prevent future crises? And if not, what financial risks does it fail to address? And what do you plan to do about those risks?
That's a good, challenging question for the last one. So first, I guess I'd start by saying, although what you say about the sort of spate of legislative activity in the 30s is true, it is also true that for 60 or 70 years or more, that essential framework, the one that was created in that sort of couple-year period in the early mid-30s, established a framework that allowed our financial services, our financial markets and our financial services sector to exist on a stable, strong platform in ways that allowed it to generate, to intermediate an enormous amount of investment and innovation and economic growth, the likes of which the world has never seen. And it is true, of course, and we see it now, we know it empirically, that at some point, that extraordinary set of things that were put in place at that time outlived their capacity to actually protect the system. And there's a range of reasons for that. And the literature is already big, and it's getting bigger by the nanosecond as to what exactly the causes were and all of the sort of the etiology, if you will, of the crisis. But it was awfully good for an awfully long time, and the envy of the world, and I would make the strong argument, the best it's ever been. So now we need a new set of things, and that's really what we've just been about trying to create in the continuing process of creating. My crystal ball is not 70 years clear. Might not be 7 weeks, probably not 7 days clear. But I think that the goal here was to create a framework that that had the capacity to deal with, to bend to be flexible to a financial services world, a set of markets that morph at a shocking pace, that are changing and innovating with lightning speed, and that create the governance structures and the authorities to allow the government to do things that will substantially lessen the probability of crisis. So it's all the things I mentioned and other things as well, but the core of it I mentioned, looking at the big, most complicated firms, the kinds of firms that have the capacity to create that problems on that scale, and treating them in a very different, more consolidated, sort of more synoptic kind of way, to make sure that the basic prudential rules are a bunch more robust, that buffers are higher, the margin for error is extended a whole bunch, to make sure that opportunities for arbitrage in the system are squeezed out, that gaps where risk started to build up, the non-bank sector being, broadly speaking, kind of a classic thing. The derivatives markets, another, broadly speaking, big thing, are treated seriously. But to give the government tools to adjust its approach over time as the world turns and as markets innovate and as our understanding of risk changes and advances. And then importantly, to make sure that the government also has a set of tools on the back end so that if there is stress again, and there will be stress again, the government has a better capacity to deal with it than it did over these last few years, where the options were thin and they were pretty suboptimal, and we saw kind of what happened. So this is not meant to be a magic elixir. This is meant to be a serious, rigorous set of rules that we think has the fundamental basis covered, the things that not just relate to fighting the last war, which is the tendency of folks in government and out of government to do, but also to create the flexibility to fight wars, if I could use that metaphor again, that we can't conceive of quite yet, but that will no doubt be coming around the corner.